Good morning. I'm here with Ludovic Subran, Chief Economist of ALLIANZ. Ludovic, are you expecting a recession for 2023?
I do think we're going to have a recession. I think it's going to be a mild one, but the hard data confirm the downturn. It's been maybe delayed compared to what experts were expecting because there was resilience. There were, order books that were full. There was a lot of cash on balance sheets. But I really do believe that the Fed, by increasing interest rate, is creating very tight monetary and financial conditions. So you see people, especially on the mortgage side, the households are very affected. You see companies' access to financing being affected. So I do believe we're going to see a recession, but it's going to be a short one. And I think as soon as the monetary and financial conditions stabilize or even pivot, so that's the famous Fed pivot, I think there's going to be a recovery. So it's going to be V-shaped. In Europe, it's much more complicated because we have an energy quarantine. So as long as we don't have a long-term solution for the energy crisis, we may have a recession or not. I saw many political leaders in Davos saying there's going to be no recession. Chancellor Scholz, President Macron, okay. But that means they're going to have to avoid the recession by spending more money. And so it's not really good, to avoid a recession in that case because we're going to be maybe in the positive territory, but for bad reasons. It's not going to be because the private sector grows or invests or consumes. It's going to be because governments are trying to avoid recession, whatever it costs. Yeah. Today, the situation of the energy sector is a bit better, but comes winter 23, I think we're going to again have some fears accruing on what the outlook is. So maybe no recession in Europe, a very mild one again, but the recovery is also not a given compared to the US. So maybe a more complicated situation on this side of the pond.
So do you think there's going to be a different situation in different parts of the world? And what about China?
Yeah, I think China, at least in 2023, China is going to be a big part of the story with the reopening because it's going to create a bit more growth, but also a bit more inflation, sucking up maybe some gas and oil along the way and creating yet another price surge on the commodity market. I think China is also showing the way after a very difficult sequence, I would say, on managing COVID and the economic interests, the health and economic arbitrage. I think China is also thinking about how to use policy tools, so supporting the mortgage sector, supporting the real economy, avoiding a wave of defaults. So I think China is on its path to having a bit more growth than expected, but also creating a bit more bullwhip effect on the world, a bit more inflation, and also a bit more credit risk. So I think we're going to be watching China a bit more this year than last year, for example, on its effect on the recovery or the recession.
Where do you think inflation is going to be worse by region? Europe or US or somewhere else?
I think inflation has peaked, but prices have not. So as a consequence...
How does that work?
Well, inflation is a growth rate, right? So inflation can actually go down to 2%, but that still means prices are increasing 2%.
Okay.
So on companies' margins, on cost of financing for governments, on purchasing power of households, we still have a very different environment from, a year ago. In my country, France, the debt servicing cost for the government was 30 billion a year ago. Now it's 50 billion. So that means, the cost of just functioning, the mere functioning of the state cost has increased by 20 billion, just like that. For companies in the hospitality sector, in the construction sector, the debt burden, the debt servicing cost is creating a shock of almost 1 to 2 points of margin. And for household, the interest rate shock is almost 1 point of purchasing power. So, through inflation and interest rates, we see accruing effect on the cost of the profitability for companies and on the purchasing power. And so that does mean that we are going to continue to see a bit more triaging between those who had resilience embedded and those that were a bit more vulnerable. So where is the inflation the worst? I think in the US, inflation has peaked a bit before us, but it is manageable by central banks. In Europe, it's a bit more complicated because most of this inflation is imported. So it's the bad kind of inflation. There is not much you can do. Even if you increase interest rate, even if you, try to put a bit more competition, a bit more reform, you still are dependent on inflation that is imported. And so that's why they had to go back to old toolbox, including price controls, which is quite new in a very financialized world to use price control and price caps, but that's maybe the only way to stop inflation for its negative consequences on households and companies.
What do you expect the central banks will be doing this year? Or what do you think they have to do this year?
In the US and Europe, central banks were maybe a bit late to the tightening game and maybe a bit too naive, according to at least investors. And as a result, they're going to have to a bit overdo it. So the risk now is that they go much higher to really calm inflation at the risk of creating, indeed, in the US a recession, and in Europe a bit more fragmentation or a bit more credit risk. You know, we see spreads, for example, between core European countries and periphery European countries. That's the terminology that we used to use in 2012. We're not in 2012, but it's true that, you know, what's happening in Italy, what's happening in Spain, what's happening maybe between France and Germany on energy, on pension reform and whatnot, is something that is of interest to markets, because with 3%, you know, for the ECB, maybe 3.5, 4% as key rates, this is a very different environment than, you know, a year ago. So I think central banks are going to maybe do it a bit beyond what they should do to make sure they anchor this idea that they're very credible on muting inflation. And as the result, they may pay the price of having a bit more credit risk in the US and a bit more fragmentation risk in Europe. But maybe they're going to be okay with that, because it's the price to pay for sponging up all the liquidity that has been put into the economy to fight first the virus and then Putin.
Do you think there will be permanent scarring in the economy, or will it all sort itself out eventually?
The idea that we reacted very strongly to COVID, you know, we paused the world, but we put a lot of money to avoid scarring, to avoid unemployment, to avoid insolvencies. And then again, with the war against Russia, we decided to make sure we offset the cost of the war to some of the people. I think the result of that is that we've tried to limit scarring as much as possible, but we created a lot more debt, a lot more inflation, a lot more inequalities, a lot more interventionism. So there is some form of scarring. It's not the type of scarring that we had, for example, from Lehman in 2008 or from the dot-com bubble. It's a scarring that is on the functioning of the economy rather than on, you know, unemployment or bankruptcies. And so that means, for investors at least, we need to take into consideration, I call that usually war economics. I said we are at war, we were at war against the virus, we're at war against Putin, we're now at war against climate change. That changes the law of economics. A lot more intervention, a lot more fragmentation, a lot more inequalities. This is now the bread and butter for investors to decide between good and bad deals. And this is something that is a different environment from the past 20 years. That's a form of scarring in itself, yeah.
What do you think the effects are going to be on the private markets this year?
I think the repricing of 22 didn't let, you know, the private market unscathed. You know, I think somehow there's been, if you just look at the leverage buyouts operation, minus 20%, the value of the transactions minus 40%. There is a lot of nervousness or attentism, wait and see in the private equity space. There are a lot of concerns in the private debt space also because of the corporate defaults, you know, risk going up. So I think it's a reality check. I think that's the title of IPEM's conference this time. I think it's a way to make sure that the quality or the underlying quality of the deals is important. It's a way to make sure that the segments of the markets that are the most resilient are put forward. Secondary private equity, or maybe a specific investment thesis around green, infra, or quality real estate. It's going to be very interesting to see how this conference actually identifies some growth areas. I think the good news is that the outlook looks a bit better should central banks pivot. This is going to, for example, unleash a bit the very dry financial conditions we've seen over the past year. I think the valuation correction is something that is already mostly there. There is not much more to wait. But so that's going to create, I think, a bit of repositioning, maybe, you know, portfolio reshuffling, a bit more, you know, price for conviction rather than just a premium for illiquidity or complexity. It's going to be an interesting relationship, I think, in this conference between investors trusting their private equity partners, but demanding a bit more focus and certainly a bit more conviction when it comes to why they're staying in this sector when there is clearly a bit more risk than just 18 months ago.
Who do you think is going to do better? Or what is different between private equity strategies and private debt strategies?
I think somehow private debt has shown more resilience so far. But indeed, the normalization is, a bit, this is Warren Buffett's famous sentence, when the tide goes down, you see who swam naked. So on the debt space, you've seen a lot of companies piling up debt, banking on very strong turnover growth and very strong profits, and this is a bit more complicated. So I think maybe the correction has happened faster in private equity, and now the question is whether private debt is going to take a bigger blow towards the end of the year, because there's going to be more corporate defaults, so at least they've been on the rise. This being said, I think it's very interesting to see the resilience of the private debt space. So normally, as financial conditions get tighter and stay there, it's going to be a bit more Darwinism in the private debt space, but so far it has shown a lot of resilience. So it's going to be, I think both segments are under some form of additional pressure, but both segments are showing that they can be optimized. And I think that's the good news, that there is still some sub-segments that are more profitable or more lucrative than others. And this is all about this agility of the sector. The sector is about the long term, but it's very agile and it's also full of conviction. And I think that's also very important to navigate, I would say, more turbulent times ahead for markets in general, more volatility, but in particular for private markets.
Ludovic, thank you very much for taking your time to come to the studio today.
Thank you so much.